This is Nightly Business Report with Tyler Matheson and Sue Herrera.
House of Games. Netflix shares soar on a strong quarter as people around the globe sign up to watch its original shows.
Ballot battle, why the fight to lower the price of prescription drugs is playing out not only on the campaign trail, but also in the state of California.
Ambitious plan. Pepsi pledges to trim the fat and the salt and the sugar from many of its popular products. Those stories and more tonight on Nightly Business Report for Monday, October 17th.
Good evening, everyone, and welcome. A trifecta of earnings tonight from a hot digital media company, a cool blue chip, and a big bank. And we begin tonight with blockbuster results from Netflix. The digital media outfit crushed earnings expectations and added a lot more international and domestic subscribers than many thought they would. The company says people are signing up for its service to watch its lineup of new and original shows. For the quarter, Netflix earned 12 cents a share. That was double forecasts. Revenues rose 31% to more than $2 billion. And with that, the stock took off, rising as much as 20% in initial after-hours trading. Julia Borston has more on what drove Netflix's strong quarter.
Netflix beating across the board with subscriber numbers far exceeding expectations as the company's price hike proves not to be hindering its subscriber growth at all. Netflix adding nearly 3.6 million new subscribers, 3.2 million of them coming from overseas, bringing its total subscriber count to nearly 87 million worldwide. And the fourth quarter is looking equally rosy. Netflix forecasting it'll add a far better than expected 5.2 million new subscribers, saying that these results are driven by excitement around its original content. In the past quarter, it's hit Stranger Things and the second season of Narcos in particular. As these results push the company to continue to invest even more in producing its own original content. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And now to IBM, which saw revenue fall for the 18th consecutive quarter. And this came despite growth in its cloud and artificial intelligence units. Big Blue earned $3.29 a share. That was 6 cents above estimates. Revenue came in at $19 billion, slightly lower than a year ago, but it was the smallest drop in revenue in more than 4 years. As for the stock, it was volatile in after-hours trading. Josh Lipton has more on IBM's results.
$8 billion. That was one big number in IBM's latest report, and that refers to revenue in the company's so-called strategic imperatives, or those emerging growth areas like cloud technology, analytics, and security. And that did represent growth of 15% adjusting for currency. JMP's Greg McDowell, an IBM bull, says that number is critical for Big Blue because when it comes to IT spending, that is where the growth is and where it competes with other tech giants like Amazon and Microsoft. Those strategic imperatives now represent some 40% of the company's revenue. The question for investors, though, when will those new business lines be big enough to offset the older ones? For Nightly Business Report, I'm Josh Lipton, San Francisco.
Let's turn now to David Garrity for more reaction to the tech earnings out today and what the results may mean for you and your money. He's principal at GVA Research. David, welcome. Let's start with IBM. What did you think? What was the strong point and the weak spot?
Well, for IBM, it's been a long 4.5 years for CEO Ginni Rometty to be overseeing a company that's been seeing its revenues really do nothing but decline. Now, granted, the strategic initiatives getting up to a 40% of total revenues and showing growth of 15% year over year is impressive. But in the technology sector, you have to look at companies that are out there that are growing revenues on a factor of anywhere from, say, 30 to 50%. So even though IBM, obviously a very, very large blue chip company, is seeing growth in these areas, it's still lagging other companies whose market caps are not necessarily all that different in size in terms of their revenue growth. Obviously, from that standpoint, IBM, a laggard, has done well in the market in terms of perception so far this year, but we're not surprised to see some profit taking here after hours.
So how do they change that? They have been acquisitive. Do they buy that growth in the form of another company, David, or do they have to keep trying to turn it around organically?
Well, they'll have to do both. I mean, certainly what we've got with respect to their artificial intelligence offerings with Watson, and the extent to which that's being licensed in a wide range of partnerships is certainly very promising for the company. But at the same time, IBM has been an aggressive acquirer, and we would argue will continue to be so. We don't necessarily think the IBM is going to get great value if they're to go out and acquire one large company. So from that standpoint, it's going to be a matter of being patient if you're an IBM investor and seeing them piece it together. We think that they will get to that point because we think that artificial intelligence is certainly a substantial future market, and probably IBM is the least expensive way for investors to have a way to effectively play the growth in artificial intelligence.
Quick thought on Netflix. You've called yourself a skeptic on that company. Did today's numbers change your view?
Well, it certainly made Netflix a more expensive stock than it was before, trading at about 50 times its earnings before interest, taxes, and depreciation. Certainly commend the fact that they are out there growing their subscribers as they are. They do have limitations overseas in terms of trying to penetrate markets like China. But we think that, when people look at Netflix as an investment, the fact that the company said they want to raise original content programming from 600 hours this year to 1,000 hours next year. Granted, obviously, that's going to take investment dollars. They have indicated they're going to lever up. And obviously, there's no guarantee that every show they put out is going to be a hit. At the same time, there are other companies that are out there, such as Amazon, with its Prime offering, which is also moving into original content. So Netflix does not have the field to itself.
All right, David, thank you as always. Great to see you. David Garrity with GVA Research.
Thank you, Tyler. Thank you, sir.
And now to Bank of America. The second largest bank by assets reported its first profit increase in 3 quarters, and it comes despite a drag from continued low interest rates. Bank of America's results were helped by an increase in trading revenue, just as J.P. Morgan and Citibank were last week. And on the conference call, CEO Brian Moynihan sounded optimistic.
We saw better client activity driving the best third quarter results we've had in 5 years in investment banking and in sales and trading. And we're doing that with a smaller balance sheet, fewer people, and lower value at risk, or VAR.
Shares of Bank of America rose slightly in trading today.
On Wall Street, stocks closed lower as oil prices fell and investors evaluated those quarterly results we've been talking about. Economic reports were in the mix, too, and so were comments from a Fed official. We'll have more on that in just a moment. The Dow Jones Industrial Average fell 51 to 18,086. NASDAQ dropped 14, and the S&P 500 was off 6.
Output at manufacturers increased for the third time in 4 months. Factory production rose 0.2% in September, and that rebound last month was led by the production of construction supplies and petroleum products. But a separate report on manufacturing in New York State showed a contraction for the third straight month. New orders and shipments and employment all fell.
Federal Reserve Vice Chair Stanley Fischer says the economy is very close to the Fed's employment and inflation targets. Speaking to the Economic Club of New York, the central bank's number 2 also warned of the dangers of low interest rates.
Low interest rates make the economy more vulnerable to adverse shocks that could put it into a recession. Operating close to the effective lower bound limits the room for central banks to combat recessions using their conventional policy tool. That is, by cutting the policy interest rate.
Mr. Fischer added that low rates can threaten financial stability, though he does not think that threat exists right now.
October, as you probably know, is an historically volatile month, but so far this October is turning out to be relatively calm, and that may be just what investors do not want. Mike Santoli explains.
Even after some choppiness in the past week, the stock market has been uncommonly calm so far in the typically unsettled month of October. The S&P 500 index has traded in a narrow range this month and is less than 3% off its record high. Yet investors looking for a nice fourth quarter rally should probably be wishing for some more nervous trading and a deeper pullback in the second half of the month. That's because pronounced October weakness is often the setup for a strong finish to the year. The average fourth quarter return since 1970 has been 3.9%. Yet in the past 25 years, an October pullback of at least 3% when stocks weren't already in a bear market has led to an even better fourth quarter gain, near 7% on average. The bear market bit is significant. In 2000 and in 2008, with the U.S. economy in recession, an October drop preceded further declines. Last year offered a bit of a counterexample. October was unusually strong, with stocks rising 8% as the markets recovered from the deep late summer sell-off. Yet the indexes peaked in early November, and the market went on to suffer a nasty correction into February. Of course, these seasonal factors are simply broad tendencies and not laws of nature. Corporate earnings results now being reported will help dictate the direction of the market, along with the direction of bond yields and whether the Fed's expected December rate increase generates much financial stress. But history suggests a good October scare that drops the market 3 to 6% can give way to a strong sprint into the new year. For Nightly Business Report, I'm Mike Santoli.
Look at all those people having fun there. All right, still ahead, pricing pressure. California tackles the rising cost of prescription drugs with its own ballot initiative this November. But what is the right way to fix the problem?
Visa's CEO is stepping down. Charles Scharf says he can no longer spend the time in San Francisco necessary to do his job effectively and wants to be closer to his family in New York. Former American Express president Alfred Kelly will take over the top job at the world's biggest payments network starting on December 1st.
Fellow Dow component Caterpillar will also see a change at the top. CEO Doug Oberhelman will retire earlier than expected and step down at the end of the year. He has been with the company for 41 years. He'll be replaced by Jim Umpleby, the current head of Caterpillar's engine business.
Pepsi is making some big changes. The company not only wants to cut sugar, but it's also making a commitment to the environment. Sarah Eisen talked to CEO Indra Nooyi about her newly outlined long-term strategy.
PepsiCo is setting some ambitious goals for itself. It's all a response to both consumers eating healthier and increased regulatory pressures to cut salt and sugar. Specifically, PepsiCo now says 2/3 of its beverages will have no more than 100 calories from added sugars per 12 ounces by 2025. Beverage Digest says that's now about 40% for Pepsi, so there is work to do. And there are risks, costs for one, and also that it tastes good. The company also wants to cut salt levels and saturated fat in Frito-Lay chips, Doritos, and other salty snacks.
That was a challenge because people love fried snacks. So we had to really invest in technology to reduce the saturated fat levels. It's taken us a while, but now we've done two things. We are frying our snacks in many countries in heart-healthy oils, and we have a technology breakthrough, a significant technology breakthrough, which is now commercially being adopted in China, which is a new frying technique, which actually reduces saturated fat levels by about 20% and increases capacity of the machine by 25%.
Pepsi has been moving away from carbonated soft drinks and cola at a time when Coke is doubling down. In terms of snacks, Mondelez, the company behind Nabisco and Oreo, says it is cutting sodium and saturated fats by 10% by 2020. So companies are setting their own targets and moving to follow the consumer. That includes efforts on sustainability as well, something Pepsi is laying out.
We've been maniacally focused over the past decade and will be over the next decade to reduce the water use in our operations and ensure that the entire community around us is water positive. Okay, that's our goal, to make sure that we get welcomed into communities and societies, not shut down by communities and societies. And by doing so, we actually save money because we don't have to pay for water to run our operations. Our sustainability initiatives have saved us $600 million. So I'd say to you, environmental sustainability is not a nice to do, it's a fantastic profit-driving initiative, which also is the right thing to do for societies and communities.
As a result of better bottom line performance, Pepsi stock is up 7% so far this year, outperforming many of its competitors in food and beverages. And today we got a big picture view at how the company wants to keep that up in the future. For Nightly Business Report, I'm Sarah Eisen.
United Continental's results fly above expectations, and that's where we begin tonight's market focus. Despite seeing a drop in profit and sales, the airline did manage to beat analyst estimates. The company also reported a narrower than expected drop in passenger unit revenue, but said it expects that to fall between 4% and 6% this quarter. Shares ended the day down fractionally at 53.03. Super Value said it plans to sell its discount grocery chain Save-A-Lot to a private equity firm for more than $1 billion. Last year, the supermarket operator said it was considering spinning off that division. Super Value shares rose nearly 6% to $5.30. Tesla and Panasonic have signed a non-binding letter of intent to manufacture and produce solar energy products, but there's one caveat. The electric car maker said the agreement only goes into effect if Tesla's proposed acquisition of Solar City receives shareholder approval. Tesla shares were down 1% at $193.96. Hasbro topped sales estimates thanks to strong demand for the company's line of Disney dolls and Furby toys. Hasbro also benefited from stores increasing their product inventories ahead of the holiday shopping season. Profit also better than expected. Shares up 7% on the day to $81.82.
Charles Schwab saw profit and revenue rise as an increase in fees and brokerage accounts helped results top analysts' expectations. Shares were off nearly 1% to $31.69. Trucking and transportation company J.B. Hunt saw its earnings take a hit, due in part to weak demand for services and a rise in driver wages. The company also said higher maintenance costs contributed to the worse-than-expected profit. But overall revenue did rise. Shares, though, fell almost 2% to $78.45. Constellation Brands will sell its Canadian wine business to a pension fund for nearly $800 million. The parent of Corona Beer and Svedka Vodka also says that it plans to buy several brands from a private wine company for $120 million. Shares finished the day down 1% to $167.13.
The high price of prescription drugs is not only a hot topic nationally, but also particularly so in California, where this weekend Vermont Senator Bernie Sanders campaigned in favor of a controversial ballot initiative that he says would help lower prices. But as Meg Terrell reports, not everyone's in favor of it.
It's called the California Drug Price Relief Act, and support may be gaining steam heading into Election Day. Also known as Prop 61, the act would bar California's state agencies from paying more for prescription drugs than the U.S. Department of Veterans Affairs. The VA is allowed to negotiate with drug companies, something Medicare, for example, can't do. And proponents of the bill say it could save Californians more than $5 billion over 10 years. Proponents who include Senator Bernie Sanders, who rallied in support of Prop 61 in San Francisco on Saturday.
Stand up to the greed of the pharmaceutical industry, which is charging us by far the highest prices in the world for prescription drugs, while they're making tens of billions of dollars in profit every single year. That's wrong.
It's shaping up to potentially be the most expensive ballot initiative ever seen in California, with more than $100 million in donations, the vast majority of which oppose the measure. Some of the biggest opposition funders, Big Pharma, Merck, Johnson & Johnson, and Pfizer lead the way. But those opposing the bill also include veterans, who fear the result wouldn't be lower prices for everyone, but higher prices for them. That drug companies would respond by eliminating some of the discounts that now go to the VA. And major California newspapers have both weighed in against Prop 61, citing potential unintended consequences.
You have a real divide on policy. Republicans, both nationally and in many states, seeing the issue as one where they don't want to limit research and development, as opposed to supporters of ballot initiatives like this who just want to flatten the prices regardless of whatever the other impacts might be.
But many Californians support the bill. Two polls done in July and September put support for Prop 61 at almost 70% among state voters. Opponents say that's a dangerous position.
Polls were taken a number of weeks ago, and we think that when they take a look at the details in Proposition 61, they'll recognize that this is a flawed initiative that won't work.
The financial impact to pharmaceutical companies, though, may be limited if Prop 61 is passed, according to RBC Capital Markets. Its research shows a decrease in revenue of about 2% in 2017 and 2018 if reductions stipulated in Prop 61 were stretched to all 50 states, something RBC sees as unlikely. But the political focus on high drug prices looks like it's not going anywhere anytime soon. For Nightly Business Report, I'm Meg Terrell.
So with California getting in on the battle to stem soaring drug prices, is this the best solution, letting states fix the problem, or should it come from the federal government instead? Michelle Mello is a professor of law and professor of health research and policy at Stanford University, and she joins us now to talk about that. Professor, welcome. It's nice to have you with us tonight. I guess the question we're posing is, we know we have a problem with soaring drug prices. Is it better to be federally mandated or state mandated?
Well, as in many areas of health policy, the types of initiatives that we're seeing out of states are not the first best solution, but they're the solution that appears to be politically feasible at this particular moment in time.
I assume that's because there is no consensus in Congress or between the administrations and Congress on how to handle this. I'd like to go to the question in front of the voters, is Proposition 61. And one of the concerns is those unintended consequences. In other words, if you reduce prices for the state workers in California, for retirees, current employees, people who receive Medicaid assistance and so forth, that somewhere, somehow, the prices are going to go up, maybe even for veterans in California, as a result of this. Do you share that view or worry?
Well, I think any economist would share that worry. The fact is the matter that there's not one drug price in the United States. There are hundreds of drug prices, and without regulation that prevents companies from raising prices in one part of the market when they're forced to constrict them elsewhere, there's always the prospect that companies will gain the system. When one payer pays less, another payer pays more.
Do you think that the industry, though, if indeed this proposition does pass in California, they've been under an enormous amount of scrutiny and criticism because of soaring drug prices. Do you think it might act as a deterrent to them if this proposition passes so that they don't continue to raise prices, or not?
You know, it would be great if the industry saw initiatives like this as a strong signal from the public that they need to take voluntary action to rein in cost growth. I'm not convinced that will happen. I think where we've seen action by the industry, it has been in response to a very discreet and acute outcry, for example, over the EpiPen pricing by Mylan. And it's also been very limited in nature. Companies have adopted solutions to attempt to respond to public concerns, like offering discount coupons. But at the population level, those solutions don't tend to save us money. In fact, they may cost us money. So while I'd love to see an industry-led solution here, I'm not optimistic based on what we've seen so far.
You began the discussion with a very interesting answer. You said that this is a solution, but probably not the best solution. What would be the best solution in your view?
Well, drugs are a national market, and that calls for a national solution. But Congress, in its wisdom, when it passed the Medicare Part D Act back in 2003, chose to explicitly state in the law that Medicare was not going to be permitted to negotiate the price of drugs, as it does for other services. This is really an extraordinary step to take. I know you said there's no consensus in Congress about how to do it, but there was a consensus, and the consensus is, let's devolve that responsibility to hundreds and thousands of individual pharmacy benefit managers. So that creates a very fragmented market where each manager and each payer is pitted against one another, and we're not able to effectively negotiate prices. So there are a number of strategies that our Congress could consider, that other countries have pursued, that would still maintain a lot of our market approach, but impose some discipline on a very undisciplined market.
Professor, thank you very much for joining us tonight. Professor Michelle Mello with Stanford University. Coming up, Extreme Makeover, a classic and iconic home is taken into the 21st century.
They are the iconic homes of San Francisco, the Painted Ladies, as they're known, and now one of the Victorians is getting a very modern makeover. Aditi Roy has our story.
At first glance, this iconic Victorian house in San Francisco has stayed remarkably the same since it was built in 1892. The newest owners have preserved the gas lamps and the ornate chandeliers reminiscent of the era. But on the roof of the house, you'll find something unmistakably modern: solar panels used to capture the sun's energy and power the home.
We're big believers in sustainable energy and renewable sources of energy, so we always thought, wouldn't it be great to get solar on this house?
Combe Lagoo says he and his wife chose to go solar because it also makes financial sense. Sunrun, the solar company that the Lagoos hired to make the switch, says they offer the installation to their customers for free, as long as clients agree to let Sunrun manage their electricity for 20 years. The company says by going solar, the average customer reduces their monthly electric bills by 20%.
The benefits for going solar first are cheaper electricity. You don't have to compromise to switch over to solar, and that's news to a lot of people.
The Lagoos are part of a growing trend. The Solar Energy Industries Association reports 1 million Americans currently have residential solar power. And the group projects the solar industry will grow 85% year over year. Part of the reason for the explosion of growth is a government tax credit, which went into effect the end of 2015 and has been extended through 2019. The Lagoos hope by switching over to solar power, they'll show other potential customers that sometimes even the most traditional home needs something new.
Having a solar system on the roof really doesn't impact us day to day. We just feel good about the power that we consume.
They've also included other modern technology in this historic home, outfitting it in smart tech, like a dual-zone furnace and even an automatic wine dispenser. For Nightly Business Report, I'm Aditi Roy, San Francisco.
What a beautiful home.
Yeah, lovely place.
Really pretty. That does it for us tonight on Nightly Business Report. I'm Sue Herrera.
And I'm Tyler Mathisen. Thanks very much for joining us. Have a great evening, everybody. We'll see you back here tomorrow night.